Benchmark, the voice of business. Presented by LMD.
On this week's edition of Benchmark, an overview of global biz news makes up our lead story today. Then in our feature segment, we turn the spotlight on Chris Gibson-Smith, chairman of the London Stock Exchange, for his take on LSE's merger with Millennium IT and much more. And we wrap up this edition by talking to LMD columnist and market analyst Hasitha Premaratna for the latest on the bourse. That's the lineup for Benchmark this week. The World Bank grants $50 million to the Philippines for infrastructure development and to provide many impoverished communities with adequate physical and economic infrastructure. Hello, this is Benchmark. I'm Savitri Rodrigo. The state-run Development Bank of the Philippines, DBP, will receive the $50 million loan, and under the arrangement, DBP will re-lend to local government units, public utilities or eligible local government-owned and controlled corporations and private sector enterprises that are engaged in the development of environmental, agricultural and social projects across the islands, as well as providing services through public-private partnerships. According to the World Bank, among the eligible projects for the grant are water supply management and drainage systems, irrigation, disaster risk mitigation, building seawalls, flood protection and slope protection, and social projects like the development of school buildings, hospitals and health centers. It will also cover projects that enhance the development of transport facilities, including local roads and ports, as well as tourism support initiatives, convention centers, heritage sites and resorts. The aim is to improve connectivity and access to a wide array of better infrastructure and services, especially to poor communities. Although growth in the Philippines has been averaging about 5% over the past 10 years, significantly higher than the rate achieved during the previous 2 decades, managing projects that benefit the poor has been a continuing challenge in the islands. Poverty has remained at about the same level during the last decade, with a little over a quarter of the population currently living below the poverty line. In addition to offering direct retail sub-loans, DBP will also channel financing through wholesale loans to eligible private financial institutions for onward lending to local service providers. This will fund the Regional Infrastructure for Growth project, which will build on the bank's existing support for improved physical and economic integration. Moving on to news from Europe. Credit rating agency Moody's recently slashed its rating on Hungarian government bonds to junk status as a result of Hungary's ailing economy. Moody's cut its rating on Hungary's debt from Baa3 to Ba1, which is now just below investment grade. According to Moody's, key elements of the decision to reduce Hungary's rating centers on increasing uncertainty over the country's ability to meet its medium-term targets for fiscal consolidation and public sector debt reduction, as well as increased vulnerability to event risk given the marked volatility within the troubled Eurozone. In response to the downgrade, the Hungarian government accused Moody's of perpetrating a financial attack against the country. The downgrade means that Hungary will find it difficult to borrow from money markets, as well as having to pay a higher premium for credit facilities. In 2008, Hungary was the first EU member to take an emergency IMF-led bailout when it secured 20 billion euros to beef up its coffers. Rival rating agency Standard & Poor's also said it will continue to maintain its negative outlook for Hungary. The EU and IMF announced that they had received a formal request from Budapest for financial support, which, if granted, would be of a precautionary nature. Meanwhile, in London, an external member of the Bank of England's Monetary Policy Committee, Martin Wheal, says that the UK economy will take 5.5 years to bounce back to its pre-recession state. The bank is currently engaged in a £275 billion programme of UK government debt purchases designed to infuse more cash into the financial system. This quantitative easing plan, which aims to reduce long-term borrowing costs and enhance the value of shares and real estate prices, is expected to conclude in February. However, output in the UK is predicted to return to its 2008 level only by 2013. Spotlight is up next, and we caught up with the chairman of the London Stock Exchange, Chris Gibson-Smith, who was in Sri Lanka last week for an exclusive interview. But first, here are some messages from our sponsors.